Hi there. Discover how CIS subcontractors use self-assessment to report income, offset deductions, and understand whether a repayment may be due.
Building a brick wall requires absolute, unwavering precision. Every single brick and every line of mortar must be strictly accounted for. As a subcontractor, you apply that same rigor to your billing. You finish a job and submit an invoice for exactly £1,000. But when you check your bank account, the deposit is only £800. 200 is missing. The contractor withheld this as a 20% CIS deduction. Many subcontractors see this subtraction and assume their income tax obligations are fully settled. Accepting that assumption costs the average UK subcontractor thousands of pounds every year in unclaimed money. This is a technical briefing from Atlas Tax Advisors on HMRC compliance. The construction industry scheme is strictly an advance deposit against your future tax liabilities. It is not a final tax rate. This briefing is for UK sole traders working as subcontractors, particularly those earning between £30,000 and £60,000 annually. We will demonstrate the math behind your overpayment and detail the compliance steps required to recover those funds. Understanding the underlying mechanics of CIS transforms a perceived heavy tax penalty into a highly predictable financial asset. To see why you are owed money, we have to look at the blunt way CIS extracts cash compared to the nuanced way HMRC calculates your actual liability. This diagram illustrates the CIS flat rate mechanism. It strips a 20% deduction, or 30% for those who are unregistered, from the very first pound of labor you earn. This second bar shows the actual UK tax system. Every taxpayer has a £12,570 personal allowance that is completely tax-free. CIS also ignores your allowable business expenses. It taxes your gross labor, disregarding the costs of tools, travel, and materials that reduce your actual taxable profit. When we overlay these two systems, the overlap is clear. The flat CIS deduction cuts deep into income that your allowances and expenses should have protected. Most subcontractors remain unaware of this structural discrepancy until they prepare their final year-end tax return. A CIS overpayment is a mathematical certainty designed directly into the mechanics of the tax system. Your self-assessment tax return is the legal mechanism where this structural overpayment must be claimed. The most frequent error triggering automated HMRC inquiries is declaring the net bank deposit as your total turnover. The golden rule of the SA100 return is that your turnover figure must always be your gross income, the total invoice value before any CIS was withheld. The CIS deductions are mapped to an entirely separate section of the tax return, box 38 on the short pages. Reporting net income artificially shrinks your turnover and creates an instant mathematical mismatch with HMRC's internal contractor data. Failing to report gross income guarantees automated flags and months of delay before any refund is issued. To legally prove the deduction figures entered into box 38, you must meet strict evidentiary requirements. The critical document here is the Payment and Deduction Statement, or PDS. Contractors are legally required to provide this statement to you within 14 days of the end of each tax month. In many cases, contractors fail to send the PDS, go out of business, or dispute the withheld amounts. When a PDS is missing, the burden of proof falls entirely on the subcontractor to reconstruct the evidence for HMRC. Proving a deduction without a formal PDS requires a specific three-part reconstruction pipeline: the gross invoice, the notation of the missing PDS, and the matching net bank statement deposit. Comparing the gross invoice directly against the net bank deposit serves as primary evidence of withholding to present to HMRC. A proactive, rigorous document trail is your only defense against missing contractor paperwork and lost tax credits. These rules apply exclusively to sole traders and partnerships. If you operate as a limited company subcontractor, your reclaim mechanism is completely decoupled from self-assessment. Limited companies must offset their CIS suffered against their monthly payee and national insurance liabilities through the payroll scheme. Do not attempt to claim CIS refunds through your year-end corporate tax return. Applying the wrong tax logic to your business entity will result in immediate HMRC rejection and compliance penalties. An incoming regulatory shift changes the timeline for CIS reporting, making tax digital for income tax. Beginning in April 2026, this affects sole traders with a gross income exceeding £50,000. The annual January tax return is being replaced by mandatory quarterly digital updates to HMRC. you will no longer have the option of waiting until year-end to reconcile your deductions or reconstruct loss statements. For high-earning sole traders, real-time digital matching of CIS deductions to invoices is an imminent legal requirement. Securing your refund depends on matching your data perfectly to HMRC's internal algorithms. Follow these 3 operational steps. Report your gross income, secure every PDS, and reconcile those figures in Box 38. For the 2025-26 tax year, your online self-assessment submission is due by the 31st of January 2027. Filing in April or May clears the HMRC queue and returns your money months faster than waiting for the January deadline. UK tax legislation is complex and subject to change. This briefing provides general guidance rather than individual financial counsel. Always obtain independent, tailored advice before submitting returns or making final financial decisions. If you are managing missing statements, delayed refunds, or entity confusion, contact Atlas Tax Advisors for professional support.